In this video, I want to highlight 10 pitfalls or drawbacks of preferred, stock investing. So every investor should be familiar with these pitfalls, and so as to be able to give you a guide on how to go about, investing in preferred stocks. Preferred stocks have several disadvantages that investors should consider. Number one is limited upside potentials. It has fixed dividend. Unlike common stock, preferred stocks are they usually offer fixed dividends, limiting the potential for dividend growth. This dividend is fixed. If they say we are giving you, let's say, $1 as dividends, no matter how the company performs, your dividend will not go beyond $1. This means that even if the company performs exceptionally well, preferred shareholders won't see an increase in dividend payments. Number two, interest rate sensitivity. That is results in price fluctuation. Preferred stocks are sensitive to interest rate changes. When interest rate rises, the value of preferred stocks will typically fall. A new issue may offer higher yields, making existing preferred stocks less attractive. So, in the case where a company pays, higher dividend, in the case where the interest rate is high, the value of preferred stocks will fall drastically in line with the amount being, the amounts of the interest rate or the value of the interest rate. Number three, lower priority in liquidation. Lower priority in liquidation. So it is subordinate or inferior to debt holders like bond holders. In the event of liquidation, the preferred shareholders are paid after debt holders or bond holders or debenture holders, have been paid before, common shareholders will equally have their own. However, they may still recover less than debt holders if the company's assets are insufficient. In the case where the company's assets cannot actually cover the outstanding, settlements for, other classes of debt holder, preferred stockholders will still have, a higher, a higher amount, compared to other classes of company, bond or stockholders, as the case may be. Number four, callable risk. When we talk about callability, we are referring to the fact that a preferred stock, is callable, meaning the issuing company can buy back at a predetermined price, at a certain date. This can be disadvantageous if the company calls the stock when interest rates, are low, forcing investors to, to reinvest at a lower yield. It's callable. In other words, you can buy back, preferred shares. That's a very important, disadvantage you must consider. And usually, if they call it at the point where interest rate is low, it's going to affect you. If they call it when the interest rate is high, it equally has its own impact. Number five, lack of voting rights. In other words, preferred stockholders have limited influence when it comes to how the company is being run because they lack a say in matters that affect the company's, day-to-day governance. Preferred shareholders typically do not have voting rights or have, very limited voting power. This means they have little to no influence over corporate decisions, unlike what is obtainable in the case of common stockholders. Number six is a dividend payment risk. Dividend payment risk. Dividends are not guaranteed. it's a disadvantage we have to take into consideration. While preferred dividends have a priority over common dividends, they are not still guaranteed. In times of financial difficulty, a company may suspend dividend payments on preferred stocks, especially if they are non-cumulative. If the company profit drops, if a company runs into losses, the company is not bound by law to pay, preferred stockholders their dividends. Except if it's cumulative, they can shift it forward to the coming financial year. But if it's not cumulative, then of course the shareholder in this context will not receive any dividends. Number 7, inflation risk. Preferred stock is a kind of fixed income instrument. The fixed dividend payments of preferred stocks may not keep up with inflation, eroding the purchasing power of the income they provide over time. It's a fixed income instrument. They pay income stream. You have that income stream coming in regularly. In a case where the inflation rate is very high, it might end up devaluing the amount or the value of whatever comes your way as dividends. So it's affected by inflation. Number 8, tax disadvantages. When it comes to tax treatment, in some cases, preferred dividends may be taxed at a higher rate than the qualified dividend from common stocks, depending on the investor's tax situation and the type of preferred stocks the investor is holding. In other words, dividend from preferred stocks are taxed at a higher rate than dividends on common stocks. That's just the basic, explanation in this regards. Please, I would solicit you subscribe to this channel. Don't forget to like this video and make your comment in the comment section, and as well as ring the notification bell. It will go a long way in helping me in my passion and desire to bring you contents of this nature. Number 9, liquidity concerns. Preferred stock can be less liquid. Preferred stocks are often less liquid than common stocks, meaning that they may be harder to buy or sell quickly without affecting the prevailing price. Unlike common stock, you can very easily buy and sell a common stock. But when it comes to preferred stock, that enhanced liquidity is not available to preferred shareholders. And this can be a concern for investors when they want to sell their holding in a hurry. They want to meet up with one or two financial emergencies. They will not be able to dispose their shares, easily compared to common stock holding. Number 10, complexity. Preferred share is a little bit complicated compared to common stocks. They have variety of structures. Preferred stocks come in various forms. You have cumulative, you have non-cumulative, you have convertible, as I earlier discussed. So making them more complex to understand compared to common stocks or bonds. This complexity can make it harder for investors to fully assess the risk and the benefits of investing in preferred stocks. And so these are disadvantages highlights that while preferred stocks can be a useful tool for income-focused investors, they are not without risk and limitation. Investors, should carefully consider these factors in the context of their overall portfolio objective and their financial goals.